And I wanted to lay out a couple of scenarios where this decision could be something that benefits you, or at least walking through the exercise, starting with a couple that lives in a common law state, and that will make sense shortly. And they have an adjusted gross income jointly of $150,000. So if they file together, that's what their adjusted gross income will say, and that's what will be used to calculate their payment. Let's assume, however, that of that couple, one of the people in the relationship has a $50,000 contribution to that total, and they have significant federal student loan debt, meaning their spouse earns $100,000 and they do not. Well, this couple may choose to file separately, right? The person who owes the student loan debt and has $50,000 of income may choose to file separately to keep that $100,000 of their spouse's income off the table. And if they do, and they were on the old version of income-based repayment, they would end up with a monthly payment of just about $228 a month. Now let's assume that they filed jointly, and now the full $150,000 is used. That payment would go from $228 a month to $1,478 a month, a $1,200 a month increase. Now, this is a scenario where it may make perfect sense, because while it typically costs more to file separately as a couple, I don't know that it would cost more than $1,000 a month more when you're looking at the savings that they would benefit from a student loan perspective. And the reason this works is when you file separately in a common law state, you each get a tax return that reflects the income that you earn. But now instead, let's take that couple and let's move them to a community property state. The community property states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. And in community property states, when you file your taxes together, you have a return that reflects both of your income. But when you file it separately, instead of each of you getting a tax return that reflects your income, they take the entire household income and they split it down the middle. So in our scenario, instead of having one person get a tax return with $50,000 and the other $100,000, they would take that $150,000 total and split it down the middle, so each received a return with $75,000 of income. If you're looking at our scenario now, the person who made $50,000 by filing separately, they're actually adding $25,000 to their adjusted gross income, which works against the goal of reducing their income. So it doesn't necessarily work in this scenario if you're the lower income earning taxpayer, but where it works very well is if you are the higher income earning taxpayer and you have significant federal student loan debt.